Hey, it's Paul Olbrantz, owner of Clear to Close Brokers, coming straight to you live from San Antonio, Texas, where Danielle and I just watched our son graduate from Army Medics Training School. And so we're super excited to do that this morning. And now we're in our hotel room here doing this for you live. And we're going to talk about 2025 forecast as it relates to interest rates, both short term and long term. We're going to make some predictions about housing prices, but more importantly, it's really hard to make predictions. But I think we have some really good supporting data that's going to support where we think the market is going in both interest rates and housing prices. So what do you say? Oh, by the way, so what's going to happen here? This is our first time doing it live. So if you have a question, go ahead and post it. I'm not going to be able to see it. We're going to be monitoring and hopefully being able to answer them in the comments. If not, I'll just come back around and go ahead and answer them for you. But if you ever have any questions, always feel free to reach out. We'd love to chat with you because this is important. If you are out there wondering when should I refinance or when is the right time to buy, I think you're going to get a lot of great information from this forecast. So without further ado, what do you say we get started? So let me go ahead and make me small and make the forecast big. And first, what we're going to do, we're going to start with the Feds. Now, remember, the Feds control short-term interest rates, things such as home equity line of credits, credit cards, auto loans. They do not directly impact 30-year fixed rates. So when the Feds reduce the interest rates, it's very common for me to get calls saying, hey, the rates just dropped 0.25%. Can I relock? And the answer is no, because it does not directly impact it. However, 30-year fixed rates are impacted by mortgage-backed securities or bond traders. Bond traders are paying very close attention to the Fed because, just like the Fed, bond traders are worried about inflation. They don't want to give out too low of interest rates. And, if inflation is going to continue to grow and be stuck with a worthless bond. So what the Feds do, but also what they say is extremely important to 30-year fixed rates. So let's start with their predictions here for 2025. Now, remember, if the Feds keep interest rates up, short-term rates up, that's really telling the bond traders or the 30-year fixed rate market that, they're concerned about inflation because they don't want inflation to continue to rise or it's not where they want it to be. So it's really important, what the Feds do. So when we look at 2025, there's 19 voting members. And right now, if you look at the chart there, the current Fed's fund rate is at 4.375. So one member out of the 19 believes that they're not going to change the interest rates at all. Whereas if you go down, 3 believe it's going to be dropped one time, 0.25%, which will get us to 4.125. Now, the majority of the members, 10, believe that the Feds are going to drop it 2 times, 0.25% each. And at the end of the year, it's going to be a 3.875. Whereas 3 believe maybe a little bit more to 3.625. 1 believes a 3.375. And 1 believes as low as a 3.125. Now, MBS Highway Forecast, that's who it's Barry Abebe. He's the man. He makes this all possible to give this information to you. We believe that the rates for the short-term Feds are going to go all the way down to 3.375. Now, is there something that we know that the Fed members may not know? Well, there's one thing that we do know, especially if we look back in history, is that the Fed members their minds can be easily changed. So what's going to change it? Well, let's take a look here. So right now, if you look at the solid graph, the solid blue graph, this is where the Fed forecasts the unemployment range. And this is where the voting members believe it's going to continue to stay or be around in 2025. So right now, let's see here, 14 members believe that the unemployment rate is going to stay between 4.2 and 4.3. 5 members believe that's going to go to 4.4 to 4.5%. Now, I want you to notice that the dotted lines, this was where they believe the unemployment rate was going to be in 2025, just a few months back. This is why we say that, hey, these guys their minds can be changed and it will impact the market. So check this out. If we were able to get to 4.4%, that would surprise 14 of the members and make them rethink their decision about lowering interest rates. If we got to 4.6%, which is really not out of the question, wait till you see the data supporting this, all 19 members are going to have to reconsider their positions when it relates to lowering short-term interest rates. And if they lower, just to remind you, if they lower the rates more than they originally anticipated, hey, that's going to be really good for 30-year fixed rates and the bond market. But here's the catch. This is what everybody is so focused on, not only unemployment, which we're going to get to a little bit more in detail in a second, but let's talk about inflation. So this may get a little complicated. Let's see how well I can explain this. So right now, as of November, the core PCE, which is what the Fed is focusing on, their target number is 2%. Right now, we're at 2.8%. We've been lower than that, and now it's crept up a little bit, and that's kind of what's pushing up interest rates for the most part. Shelter represents 18% of the core, and right now it's at 4.8% year over year. But I need you to pay attention to this because this is very important. Shelter, how it's calculated, is not real-time data. What it does is it takes a 12-month average, and that is going to be the number of 4.8%. So here's the thing. Let's take a look at a result of real-time data when it comes to where shelter is today. Well, if you look at CoreLogic Rent Index, shelter is only up 1.7% year over year, where shelter, just because in how it's calculated in core, says 4.8%. That's simply because the numbers that have been replaced are higher than they currently are today. And we're just not getting the readings we need. So we know it's lower than what shelter is saying, which is actually keeping the core PCE up. But check this out. So 4.8% in PCE minus 1.7% CoreLogic. So it's essentially 3.1% overstatement. Now, if you take that based upon core weighting of shelter, the results, in the core PCE reading would be an overstatement of 0.5%, which would give you a core PCE should currently be at 2.3%, which is much closer than the 2%, or to 2% than the 2.8% that it's currently reading. And so with data like this would force the Fed members, the 19 Fed members, to really reconsider how many rate reductions they'll have in 2025, simply because the shelter is just not accurately reflecting of where it's at today. Now, keep in mind this is very important. It doesn't mean rents are going to go down. Some places they might. They're still going to increase from where they're at, but not at 4.8%. They're going to increase just up at 1.7% year over year. So let's get back to the monthly shelter readings in PCE. So here, if you take a look at the last 12 to 24 months, I mean, you see it's clearly coming down. And as we get new reports in, we're going to, the higher numbers of shelter are going to be replaced with lower numbers in shelter, which is going to bring that inflation figure down, which is going to make, some of the Fed members rethink their position about short-term rates. This is something, though, that I misunderstood, and I wanted to add this slide to this presentation. Just if you take a look at the purple line, that is actually the cumulative inflation number. Now, if you look at the red line, that's the yearly. Even if inflation drops, that does not mean prices are coming down. What that means is that the rate of appreciation is going to slow down. So I wish we could say that, hey, my last trip to A&W root beer cost me $50. Maybe next month when it comes down, it's going to be $30. No, that's not the case. It's just not going to continue to increase as fast as it has in the past. How impactful is core PCE? You say the 30-year fixed rates. Well, this just came out on Tuesday. Was it Tuesday or yesterday? I get confused on the days here. Core PCE came in at 3.2%, which was under expectations of 3.3. So in other words, inflation was lower than what the market expected. Now, what you're looking at here, just hang in there with me real quick. This is the actual 30-year fixed rate bond trading market. This is what we follow. This is how we know what interest rates are going to do. This is interest rates change on a daily basis. So let me give you just a brief summary. As the trend goes down, interest rates go up. As that trend line goes up in price, interest rates go down. So when core PCE came out this week, I want you to notice that huge increase that we've received in interest rates. I said that wrong, not increase in interest rates, a benefit in interest rates. Interest rates actually decreased this week substantially on the news of lower inflation. Right there just shows you the impact that the market will have as it relates to inflation. Let's switch gears a little bit. Let's go ahead and look at labor. Now, why labor is important to inflation? The stronger the labor market, the more you're going to have to pay employees to retain them. That increase in cost is going to be passed on to you, the consumer, through the goods and services that you use. So that's going to put an increase on inflation. So a weakening labor market is actually good for interest rates because that shows that inflation, that's going to calm down inflation. So let's take a look at, and this is, remember those first couple slides when we were talking about the Fed's changing their minds about lowering short-term rates. So this is why we think they could be surprised at unemployment rising to that 4.6 level. It's not unheard of. So if you take a look back from January 2023 all the way to present, you can see that the unemployment rate, it's rising. Now we have ups and downs, but as a whole, it is rising. Now this is the duration of employment. So this is between jobs. So what we're also seeing is unemployment rising, and the time between finding the next job is also increasing. In fact, over the last 7 months, that number has increased by 21%. I mean, just take a look at this chart right here. In 2024, 2023 closings, you have business, you have Party City, Big Lots. I mean, Barry B mentioned this, Macy's, 65, stores, but just imagine the amount of people that they hired. I mean, the layoffs are huge. And by the way, just because they close in 2024, that's going to trickle in to 2025, and that's going to put that upward pressure on employment. So now we know unemployment rate has a trend of increasing trend. We see the duration of weeks of finding a new job is also increasing. We're seeing these stores being laid off. What about job openings? So job openings, if you go back from April 2020-ish, there was about 12 million jobs that were opened compared to October 2024, 7.7 million jobs. So, and this is just, all of these numbers are pointing to the job market or unemployment rate increasing over the next year, which again, I know I'm repeating myself, is going to put the 19 Fed members in a position to reconsider their short-term, if they should lower the interest rates or not. All right, a lot of you came for this. Let's talk a bit about mortgage rates. So, excuse me, what we're going to talk about here before we begin, we're going to talk about the 10-year Treasury. So if you don't have access to mortgage-backed securities, you can't follow yourself. If you watch the 10-year Treasury, it's actually a really good indicator. It's not perfect, but it's an indicator of where 30-year fixed rates are going to be. So let's take a look at the 10-year Treasury. So you notice as right now, sorry, I don't know why I'm stalling. Right now, the 10-year Treasury, this is not up-to-date information. It's about 4.5, 4.6. The target rate we think is going to be that 3.6%. It's hit that mark quite a few times, But why we see that is you see that huge increase right there. That's resulting of unemployment numbers coming in better than expected. And so what's going to happen is all these numbers that we've just looked at with in terms of employment should start seeing some weaknesses, and that's going to put a reverse impact on the 10-year treasury and bring it down to that 3.6 level. Now, okay, so what has that got to do with 30-year fixed rates? So there is this the spread between the 10-year treasury and 30-year fixed rates should continue to narrow. Now, it's not perfect and there's not an exact number, but as Barry says, we can take a look at history, and history will give us a good idea of the difference between the 10-year treasury and a 30-year fixed rate. Let's go ahead and take a look. So if we go way back into the 1990s, I almost said 1900s to make it more dramatic, you can see that the average gap, right, the spread between the 10-year treasury and the 30-year fixed rate is between a 1.6 and 2%. So what that means is, let's say that the 10-year treasury was at like 2.2%. You add 2% to that, the 30-year fixed rates would be at 4.2%. That's the idea behind this. Now, I want you to notice back in 2023, you saw a huge spike in the difference, followed by a huge decrease, and then yet another spike when we got to October 2023. That gap of 3.1%, that was a result. That's kind of a one-off. That's when rates were really high. And servicers that serviced the loan that you make your payment to, they had to increase their servicing premium because at rates at 8%, they knew they weren't going to hold them long. So in order to justify holding the mortgages and servicing them, they had to increase the premium. And so that was passed on to you as the client through higher rates. And that's where we got that 3.1%. But you can see from then till now, it's starting to currently, that gap is coming down. And currently we're at about a 2.5%. So it's a downward trend. Let's assume we get to 2.5%. Or 2.25%, excuse me. So if we can see the 10-year treasury come back down to that 3.6 mark as a result of the unemployment data coming in weaker than expected, that spread narrows between the 10-year treasury and the 30-year. That gives us 2.25 at 2.25. We could see 30-year fixed rate mortgages in 2025, within the next 6 months, from where they're at today, the high sixes, maybe even low sevens, all the way down to the 5.875. So there is sufficient data here, especially if you're looking to buy a house today, that you're not seeing many buyers out there getting your offer accepted, getting your closing costs paid for. This is just telling you with this data that you may have a great opportunity to refinance and lower that rate. Whereas this is what I've seen, and if you've been looking in this market, you're seeing the same thing. When rates start hitting that 6.5, 6.25, all of a sudden the open houses are really starting to get packed. More people are getting out there and starting to look at at the homes. And why is that? Well, this depends on how you look at it. This could either really defeat people, or this could really encourage people, because what we're about to talk about is going to show you not only why home values have increased, or have not only increased, but have held even with these higher interest rates, but perhaps why there's a lot more equity to be had, and it's still a great time to buy. So first, let's look at a national level. So right now there is 136 million households. That's a lot of households. Of that 136, 45 million are being rented. Of those renters, there's no equity, and so there's no average equity per household here. But let's take a look at the owned. There's 91 million homeowners out there. There's 37 trillion in total equity. On average, the homeowner in America has $407,000 in equity. So here's the thing. So people that think there's a crash coming, the data is just not supporting it, especially when you hear in a second here. So right now, of these houses, 35 million are free and clear. That's $20 trillion, and that's 571,000 in equity per household there. Mortgage is 56 million. There's 17.3 trillion. So there's about 311,000 in equity there. But check this out. This is negative equity. There's 1 million in negative equity with a negative 0.3 trillion. The numbers just do not support, especially a 2008. If anything, it shows the strength of this market with the amount of equity. And by the way, a lot of these people have those low 2% interest rates. They're not moving. So let's talk a little bit about who is going to be buying here. So, excuse me, you look at the demographics in Destiny. So you have boomers, right? You have Gen X, you have millennials, you have Gen Zs. If you always wondered which one you were, here you go. Based on age, this will tell you where you're at. The millennials, there's 73 million millennials. Their median age is 35. Their homeowner rate right now is 45% of those 73 million. The millennials with a median age of 30, there's 40 million total. Their homeowner rate is 33%. The next 10 years, I want you to listen to this. This is important. The homeowner rate should rise from 33% to 55% in millennials. That's going to add 8.5 million more homeowners. Okay, what about Gen Z? Right now, the median age is 20. God bless them at 8% homeownership. I didn't buy a house at 20, but that's pretty amazing. But their homeownership is 8%. In the next 10 years, the homeowner rate should increase from 8% to 33%, 25%, or 17 more homeowners from Gen Z. 17 million. That is 25, give or take, more homeowners looking to buy a house over the next 10 years. All right. Well, what about supply? Okay, so there's the demand. The demand is strong. Let's talk about supply. Now, one of the things that we're so used to low amount of listings. When you start seeing 2-3 listings on a neighborhood, everyone gets really excited, like, hey, the market is changing. But what I want to share with you is pre-COVID, the average number of listings was about between 1.1 and 1.3 million homes. Now, it is true. We are up listings 27% year over year, but let's compare that to the average before COVID. Not only did we add 12 million more homeowners from 2018 to today, listings themselves are 21% down from 2018. So here it is. The demand, we have about 1.9 million homeowners. The supply, we have 1.28 million homes. This, my friend, is exactly why housing prices have continued to rise or stayed where they're at amidst higher interest rates. And that is further reason why we think that especially if interest rates start to decline back to the fives, even that 6.5, 6.25 I mentioned before, you're going to start seeing a lot of upward pressure on the home buying process. Okay, let's get to the 2025 real estate forecast. This is for the nation, and we're going to break it down here into some areas. In 2025, we see 4.1% year over year. That means if you bought a home for $500,000, I don't know where you can buy one here for $500,000, but let's just work with the example. You're going to make $20,500 in gain over 5 years. It's going to be 30 to 35%. 500K home, it's 150 to 175,000 gain just by appreciation. There is still a lot of appreciation. By the way, my favorite saying is single digit appreciation can create great wealth. Okay, what about locally? Marin County over the next year, 5.14%. Sonoma County, 5.75%. Napa County, 5.52%. Solano County, 5.2%. Contra Costa County, 5.342%. And by the way, if I did not mention your county and you would like me to tell you, send you a report of what the appreciation is going to be in your county, I'm your guy. To send me an email, send me whatever you got to do. You guys know where to find me. Okay, so here's the forecast in summary for 2025. Home appreciation 4% to 4.5. Core PCE inflation 2.1 to 2.2%, which is going to help drive interest rates down from 2.8%. The unemployment rate 4.5. If we get that 4.6%, you're going to see even lower interest rates from a 4.2. Fed's rate 3.25 to 3.5%. Mortgage rates decline to 5.75 to 6%, all the way down from 7%. Here's the deal: if we're not working together, or if you have any questions, this is my calendar right here, a QR code to my calendar. Pick a time. We'll do a hopes and dreams conversation. We'll answer your questions, get you a great plan in place for you and your family. 2025 is a great time to be a home buyer. Right now is a great time a homeowner. 2000 right now is a great time to be a home buyer. Houses are sitting. We know the rates are going down. There's no appreciation. I think I gave you the data to support that. There it is. If you have any questions, give me a call. Hope you guys have an incredible day. Thanks for your time. And with that, Paul Olbrantz, I'm out.